We're waiting on that. The flashes are coming right now. But as we bring in our Bulls and Bears, Jonas Max Harris, obviously a very tough time for Starbucks. Disney looking decent. In fact, we see that the parks and resorts were moving higher, up about 5% there.
Yeah, we'll talk about Starbucks first because I'm a shareholder. And apparently the logo change did not save the company last quarter.
You know, I think the naked woman with the nipples and everything?
Yeah, I would say the revenue thing.
Well, that's what was new. They already had the bare breasts. They just didn't have the nipples. Then they put the nipples on. It's a technical term, ladies and gentlemen.
I would say the revenue thing was largely a currency situation, but the earnings thing is a disappointment. I was hoping that company was going to come back and everyone was overselling that one. Apparently not. Getting to, I'm actually more surprised by the theme parks at Disney not doing badly because Disney's expensive. It's not like a real low-end place to go where you're like, oh, we'll step down to Disney, like going down to McDonald's from Applebee's or whatever.
5% year over year.
And
Peter?
Well, my guess would be a lot of that revenue probably came from tourists. And to them, it's a lot cheaper to fly over here rather than go to Euro Disney or something like that. Not so much with Starbucks. People are trying to cut back anywhere they can. You know, we don't have the numbers out of Visa yet. But if Visa's numbers don't disappoint, eventually they're going to be. Because probably a lot of Americans who did go to Disney charged it on their Visa. And you know what? A lot of people are using their credit cards now. They have no money. They have no home equity. And it gives a lot of revenues. But they're not going to be able to pay it back.
Toby, the fact is not only Europeans coming here, but their operations overseas provide a lot of euros, which are worth a lot of dollars these days.
Well, look at it. I mean, when you could go to Disneyland,
we're talking about Disney right now.
Yeah, Disneyland is not inexpensive, but when you can pay for it with a 50-cent dollar, I mean, it's amazing. When you're down at Disneyland, I swear you think you're in London because everyone talks like this exactly. It's tremendous.
But,
the other side of it is... Go ahead. Go ahead.
I just want to jump in and just mention this one thing about Disney. Disney has done a ton of marketing and has really, really been promoting itself as a place to be this summer. So I think that's really helped. I mean, internationally as well as domestically. And so I think that's really been a big key for them. And they've also been doing a lot of promotions to do that, discounts.
And they have Hannah Montana, Gary Kay. Come on.
Absolutely.
Yeah, look, but you got to realize, as you said, Disney is not just the theme parks, even though the theme parks have been doing great. It's ESPN, it's everything else they own. And they've just been firing on all cylinders. They've literally not missed a beat over the last year. And I got to tell you, as far as Starbucks, whenever you see companies shuttering stores like they are, not good news. Not good news for stock. And I just completely
Jonas,
stay away from it. I
as a
think the stock is going
shareholder,
lower.
what do you think about the shakeup that they've had? That major management shakeup, in addition to closing down the stores. Are you going to hold on to the stock?
I am. The management shakeup to me is just a give me to Wall Street. I look at the store closings as more important, and I do think they overexpanded. They were kind of just basing growth forever, and I'm more concerned it's not trendy to have coffee anymore than a short-term issue where people can't afford it. That'll go away. The stock will come back. If we see a movement away from coffee, as you want 4 or 5 times a day, a $5 coffee, that's a dangerous permanent situation for Starbucks. I don't see that happening. I would sell the stock, though.
Well, Jonas, the government should regulate it. Shouldn't we pass a law that says you can't have 4 coffees a day?
Easy now, Mr. Libertarian.
Yeah, Peter, I mean, a company that sells a $5 mochaccino, if you get the big size, is obviously suffering today.
Expensive coffee is an easy place to cut back. Americans, Americans are brown bagging their lunches now. They're not even going to restaurants. They're doing all sorts of things to save money, and Starbucks is a place they can go. And you know, they've got stores, in some areas there's Starbucks within a few blocks of each other.
Well, Jennifer, as Jonas is about to have a conniption fit here with what Peter just said, it is true. You track this very closely. It is true that people are cutting back on the expensive items, the expendable expensive items like a $4 cup of coffee.
There is, but there are those affordable luxuries that they're going to take along the way, and Starbucks might represent one of those. I think that's what's happened with Starbucks is, A, the cannibalization of the stores. They freely admit that that's a problem.
Hold on a second. We got Prudential. Sandra, we got the Prudential earnings. Go ahead.
All right, we've got...
Peter. What would happen if the U.S. government lost its AAA bond rating?
Who the heck knows? Well, our Bulls and Bears panel are here to tell us, and, you know, I'm going to go for the jugular. Peter Schiff. Peter Schiff. Now, first of all, we've had AAA for about 100 years now. Do you think it's deserved right now?
Of course not. Look, remember, there are a lot of subprime mortgages that were sporting AAA ratings, and look what happened to them.
Liz just talked to the Connecticut Attorney General who's about to sue somebody for that.
I mean, we're a subprime nation at this point. I mean, anybody that buys our debt...
We're subprime?
Yes, anybody that buys our debt is not going to get paid back. Ben Bernanke is assuring that. All these bailouts are coming at the expense of inflation. We're debasing our money. If anybody loans Americans money, whether you're in Europe or in Asia, whatever you loan, we're not going to pay it back. The best case scenario is you get the dollars back, but you're going to see a huge loss in purchasing power, and that's what the rating agencies need to focus on. And ultimately, we're going to lose that. We're junk bonds. We're subprime. We have nowhere near AAA.
Well, let me bring in Tobin here. You know, when the FDIC says we guarantee everybody's bank accounts for $100,000, you know, their money is held in treasuries, and it just makes you wonder how many more banks are going to run into problems and how much they'll have to cash in and what that'll do to the issue.
Well, I hate to do a note of sanity here, guys, but come on now. First off, when you look at the United States as an entity, let's just look at it as an entity. Yes, we have off-balance sheet issues on Social Security, other things. Those are way, way down the road that can be fixed with actual appropriation. But all of our assets are basically run at zero. In other words, resources, lands, buildings, et cetera, all carried on the books at zero. If you take our entire asset base as a country, we so far exceed any other country that it's not even close, and that's why, dear Peter, we have a AAA rating.
But what does that have
and
to do with
number
its ability to pay us?
Finish your point, Toby. Go ahead.
And the point is that your rating is based on your earnings capacity, and because our country grows, because our country has productivity growth and population growth, we can make our payments just
I know
fine.
I want to work it around. Somewhere between Peter and Toby is Gary K. Gary, I get your missives by email, and you're furious at some of the bad things that you say we are doing, like this housing bill, which bails out some of the worst loans imaginable. But you don't see us as losing our top rating, do you?
Well, look, if it does happen, our cost of capital is going to go up big time because people are going to demand higher rates for their investments in our bonds. And let's not hope that happens. That'll just really bust it. I just found it amazing, though, the administration comes out today and says, oh, we have all the confidence in the world in our capital market, as well as things getting better, as they raise the debt ceiling to $10.8 trillion.
10.6 from 9.8, but who's counting?
Excuse me, I was off a little. For me, it's just sheer insanity to watch this continuing to go on.
I tell you, Jonas, it's almost like those kinds of statements are reminiscent of what John Thane has said. We're well capitalized, don't worry about it. I just hope that it doesn't come to the point where we lose the AAA rating for the bonds. Do you think that could ever come to pass?
No, I do not, because let's talk about sovereign debt ratings for just a second. Since it was brought up, Japan was brought up, for example. Yes, Moody's lowered their rating at one point, not too speculative, but a lower grade of investment grade. Japan has a national deficit that is about double related to GDP of America. It's like 180% of GDP.
And they don't spend anything on defense.
In other words, on that alone, and they have huge liabilities for elderly people and pensions and all that. So by that alone, we could double our debt. Double. I don't mean per year. I mean for the whole outstanding $10 trillion before Moody's would theoretically cut it.
We owe Japan $1 trillion. How can they go broke before us? Because they can call
because they have a massive amount of debt.
No, but we
can call. What is that? They can call in the debt.
They're a creditor nation. We're indebted. We're in debt to Japan over.
They have higher debts than we do, and you said.
Hold on. Gary K has the last word, and it's got to be 5 seconds. Quick, Gary.
My big worry is the trend is going the wrong way. It better turn around because one day you may see AA instead of AAA.
All right, that's the last word from Gary. That's the last word from Gary, Peter.
Thank you, David.
Look at who made...
We round out our show today with what you need to know, and we go to Peter, who's got a wonderful tie shirt combination there. What have you got?
Well, you know, Bennigan's, the retail restaurant chain, filed bankruptcy yesterday, and this is a sign of things to come. You know, as Americans finally have to cut back on their spending because they don't have any savings, they don't have any more home equity.
Toby, you have never been to a Bennigan's in your life.
Yeah. So this is a trend. This is a trend. Stay away from any of the retail stocks, anybody who's selling services or products to American consumers. A lot of them are going to go bankrupt, and the ones that don't go bankrupt, they're going to lose a lot of money.
Toby and then Jonas, because you both want to say something here. Go, Toby.
Well, first off, this is exactly what a recession is supposed to do, Peter. You know, you're the world's greatest economist, right? So you know this. What the weak are supposed to give it up, and the strong are going to come in. And I will tell you, every great restaurant chain in America started in a recession. Go look it up.
Jonas?
Interesting.
I can't look that up that fast. I will say at least 2/3 of the restaurant chains will make it through because Americans don't like cooking, and the recession will end when it starts, which hasn't happened yet. They will end, and they will go back.
I cannot even boil an egg. Tobin, what do we need to know?
All right, the vulture funds have finally got a price on this bad mortgage stuff that they're willing to buy. We saw Lone Star yesterday. We saw another. I'm an investor in a couple of these funds, and I'm getting emails every day about deals that they're working on that we're going to. That's what we were waiting for in these financials. So we're closing out most of our shorts, and we're looking at Citibank. I want to nibble at it here, but when they announce their sale, I'm going to be buying because this is what we wanted. The vultures are buying.
Gary, I heard you chiming in. What do you think of that? Citi at 18.
Merrill Lynch financed 75% of that 22 cents of Lone Star. It's crazy. Look,
doesn't matter.
I don't trust any of these companies. They have been misleading Wall Street and the public for the last year.
So what do we need to know, Gary?
I think you buy some oil here. I think you're putting a low on the oil. You can buy the USO. I think you start probing. I think we're going to start heading back up to the highs over the weeks to come. Oil stocks will go along for the ride.
Jonas, what do we need to know?
If you're looking, this is not a stock thing, this is a home buying thing. I'm coming across a lot of people looking to bottom fish into real estate, thinking prices are down over the bottom's in. The bottom is not in on real estate at this point. If you're a speculator, you want to invest in real estate, wait at least another year. I still think another 20 to 40% nationwide.
Peter, you agree on that?
Oh, sure. And it's going to be more than a year.
And you think it's going to be 95%, right?
Well, I think we're going to look. We wiped out now the gains of the last 4 years. We're back to 2004 prices. We're going to wipe out the last 4 years. We're going to go back to 2000 prices, maybe even lower. And if you adjust it for inflation, that's a huge collapse.
So Peter's already at 2004 prices.
Yeah.
Go ahead, Gary.
Peter, you must think the Dow's going to 7,000 or 6,000 because that's where it's going if what you say is true.
Well, it might go there.
5,000.
Yeah.
5,000.
It's going down, but adjusted for inflation, I think the Dow's going to be worth 1 ounce of gold.
Jonas, quick, I got to ask you about Toby's pick of Citi. What do you think?
I think the bottom fishing financials at this stage of the real estate crash is a little early.
Toby,
Tobin's done a lot of these the last 2 years, and they've not done very well.
Yeah,
but it's trading at $18.80 right now.
$16, baby. Buy it at $16. You'll be smiling next year.
16 is what he said. It is time to get happy.